Good afternoon. Wanted to catch up with everybody for a quick market minute. Volatility has continued to persist this year. There's a number of reasons for that. In July, the Fed raised rates one more time, 1/4 point, and the two subsequent meetings since then, they've kept rates steady. And what we're looking at right now is a situation where bad news is good news for the market. So the weaker the economy looks, the worse the job numbers look, the better the market's likely to do. And the reason for that is that means that the Fed isn't going to have to be as hawkish or as restrictive as what they have been. And hopefully we can get through that stage and get the inflation down into the target range of 2%, which is what they're looking for. But we did see the market peak out in July, and then August, September, and October, we saw the market start to retract. And then now, the beginning of November, the market has started back upward. But if you notice the reasons why, the Fed came out with a little bit of a different tone than what they've had in previous meetings. Not quite as overbearing or hawkish, as we like to say, as they have been in the past. They also pointed out that there is signs of improvement with inflation, and that inflation is starting to subside, and there's some positive signs inside the economy for that as well. So the economy isn't quite as bad as what some people would have you believe. It's also not quite as good either. Also too, we just had unemployment numbers tick up. So we went from 3.8 to 3.9% unemployment. The last jobs figure that we got came in well below expectations. So we're starting to see the economy slow down. I think that we're likely going to see volatility continue through the end of the year, and that returns this year will be somewhat muted or slightly positive. But the thing to remember in this time period is that whether you're doing investments into hard assets like real estate, or you're doing market investments, right now you're fighting the headwinds of the Federal Reserve, right? We're fighting against the Fed. And that's not a bad thing. It just means that it may take us a little bit longer to realize some of the opportunities that we're taking advantage of right now. So moving forward, what we're doing is we're looking at what asset classes do the best as interest rates start to go down, because we do know that the Fed is going to have to cut interest rates. Now, I can't say if we're going to go into recession or not. We've been talking about recession now for the better part of 2 years, and yet nothing's really materialized in that. So I would say that the probability of recession is still there, but we don't have any clear insight as to whether or not that's actually going to come to fruition. But if it does, we do know that interest rates get cut 100% of the time in a recession. And that's likely going to bode well for the market as well. And the Fed has already said that they're going to cut rates probably sometime later part of 2024. And as interest rates go down, there's certain asset classes that tend to respond in a positive manner to that. And so we're going to be looking to take advantage of those. At the same time, recognizing that right now is the first time in a long time that we've had the risk-free rate of return, T-bills, CDs, money markets, those types of things, that are all over 5% right now. And so we've started to incorporate those into portfolios. We've probably reached out to you to talk through that as how we split up the core group of our assets and start to add some stability to what we have. So we're looking at different asset classes like that than what we have in the past. And we're continuing to watch what happens and how the Fed reacts to this situation. Again, we're in a situation, like I said before, where bad news is going to be good news, as long as it doesn't get too terribly bad. So we'll watch that situation. We'll continue to keep you informed as we learn more and as we come into new data. I'll make sure that you guys are up to speed. But for the time being, recognizing that there's some good opportunities out there, right? And there's some good companies that have been sold off through this time period that are going to give us good returns moving into the next couple of years. And we'll take advantage of other asset classes that we believe will do well as interest rates start to come back down. We do know the Fed has said that they plan to keep rates higher for longer, but what that actually means, we'll have to wait and see. It's likely that we'll see rates start to come down, like I said, sometime next year. That's what they've talked about as well. So we'll plan for it. In the meantime, know that we're here, know that we're paying attention to what's happening, and we thank you for your trust. We thank you for allowing us to guide you through this time period and through this volatility. Remember that volatility actually works in our favor, because what it does is it reduces the prices of good quality things and good quality companies, and allows for us to take advantage of them, buy into them on a lower basis. And everybody always knows the old adage is buy low, sell high. So we want to do that. We just have to control our emotions through this time period. And sometimes that's hard, and we recognize that. So in the meantime, if you have questions, you're concerned about something, you're worried about the current state of affairs, please reach out to us. That's what we're here for. Going into next year, it's interesting, we're going into an election year, so from 1964 through the last election year, we've only had 2 years of presidential election years that were negative over that time period. So we're positive a good majority of the time. The average return, according to Forbes, is about 8%. So we'll expect to see something similar along those lines. But I can promise you that the volatility is likely going to persist, and it will be a roller coaster ride. So, like I said, if you have questions, you have concerns, reach out to us. That's what we're here for, is to help you through these time periods. We appreciate your trust in us. We thank you for your business, and we hope that we exceed your expectations in all that we do. Thank you and have a great day.